hey, we know these 5 people came to this meeting for an hour, they automatically get community equity. So in this particular situation, you're here. This meeting is a community equity meeting. It's also technically a reset meeting. The community equity is part of the Unity network. So you automatically get an hour of community equity in the Unity network. You're automatically getting an hour of community equity, in community equity. So that's basically the general context of, just tracking it, right? From there, you can obviously put it on the workers themselves. They need to give an invoice for their time. They need to send an email or add to the spreadsheet for how much time they put in any particular day, any particular project. So I think that's the easiest ways to go about it. It doesn't need to be any more complicated or less complicated than any other method of tracking time. But the cool thing about community equity is that it doesn't require the individual to send an invoice or to basically, do work in order to get paid, right? Or to get community equity. You can issue community equity directly without even somebody wanting it per se, because it's not a direct legal procedure. It's an indirect legal procedure because issuing the distribution of the community equity itself, which is more of like step 6, is separate from the actual ownership, if that makes sense.
I think I follow that. You could share any more detail on that?
Yeah, let's go back to the beginning again. So you have the idea that getting community equity set up is a very, very simple process, because you can choose the percentage, you choose your placeholder, just make the placeholder the company itself, and then it's like you're done. And the reason you're done is because the individual beneficiaries of the community equity don't directly own the equity itself, and therefore it's not a legal process for them. So it can all happen later. So the only long-term legal process that happens is that, let's say you have 30% community equity and one person slowly gains, like, let's say 10% of that, right? So let's say from 5 years from now, person A has 10% of the community equity. You could transfer that 10% of the community equity into actual equity. And in that process of transferring the equity from the community equity placeholder to the individual, that is a legal process, and that legal process has both tax implications and decision-making implications and other aspects of business law. So does that make sense?
Yeah, I think that was a really good. I feel like that's a key point that at least I know that I didn't quite understand fully or follow, and I think other people have had that same lack of understanding around that subject. So I think that was great.
Yeah, so let's think about a trust again, right? Because everything we're talking about here is trust-based, right? So the reason why ungodly rich and wealthy people use trusts is because they're basically tax havens. You put all of your assets and wealth into a trust, and then the individual, even though they're the beneficiary and they receive all the benefits of all of that wealth, they don't actually own them anymore, and so therefore they don't have to pay taxes on them themselves. The trust itself is typically set up as like a business, so if it has to pay basic business taxes, it would. But the individual who's getting the benefits of the assets in the trust doesn't pay taxes directly, and that's why it's on a legal level. Community equity is so simple and easy to implement, because even though you might have 20, 30, 40 people involved in an organization or a business that are all getting equity, you don't have to worry about all the legal shenanigans of actually issuing each of those individual people a legal piece of the pie. At least at the beginning, right? Towards the end, once you actually start establishing who and why people are contributing and what they're actually getting, then it makes sense to take the community equity and put it back into real equity so that people have like direct ownership. But usually you would do that when and if it's necessary based on the model that you're using. Does that help?
Yeah, that's great. Could you give an example of, I think you already gave one. Could you give another example of when you may turn that community equity into actual ownership equity for a community entity?
Yeah.
Community owner?
Yeah, the number one reason, especially with a startup and our type of startups, because we're community-based startups, the number one reason to use community equity is that you don't know how much contribution any individual is going to make to so we don't really have money, right? We don't have investors, right? So that means all we have is our time. So let's say you have 5 people, or in our case 6 people, who all want to go into business together. Nobody has a lot of money, right? So it's hard to split up the business based on investment. You have a big, huge component, be community equity. Everybody puts in certain amounts of time, but when you start the business, you have no idea in 2 years who is going to be putting in the most amount of time and therefore deserve the most amount of equity in the business. So you implement community equity simply because you just don't know how to break up the equity structure. 2 years later, you find out that one person didn't do jack. They didn't do anything, right? So, maybe they just don't deserve any equity, or they get very, very small amount, right? They only put a couple hours in. Another person put in like, 10, 20, 100 hours, whatever, but then they left, And maybe one person went halfway. They lasted an entire year and put in like 1,000 hours for a whole year, but then they stopped because they had to go to something else. So that's three of the 6 people right there, right? The other 3 people, let's say one of them put in like 5,000 hours, another person put in like 2,000, and one person put in more like 500. They were off and on. So basically, you take the number of hours all those people contributed, and it's 2 years later, so you more or less have a pretty good idea of how much they're contributing to the equity process of creating the company and bringing value into the company. So then you can take the actual equity, community equity, and break it out based on the actual equity they have 2 years later, and then give real equity. So basically, you're just saying we're going to wait. So instead of giving the person who left immediately 20% or 15% equity for doing nothing, we waited 2 years to find out how much contribution people actually put in, and then are basically retroactively issuing the equity based on the individuals involved. The only problem with that process, because there is a major, major problem, is that if the company has value after 2 years, which isn't always the case, right? 2 years later, a company could easily still not have any value, especially if it's starting with no money and nothing, right? So if it has $100,000 value, bam, that's $100,000 tax liability. So an individual might actually not want to transfer their community equity into real equity if the company has value, because as soon as they would do that, they would automatically receive a huge tax liability that they would have to immediately pay taxes on. Another example of that particular component of it would be an LLC. So an LLC is exactly the same thing. If you own an LLC and you make money in the company, but you don't actually get any what's called dividends, you don't actually take a draw on the company, you are fully liable for all the taxes of the profit that the company made, even though you don't get a dime. So it's exactly the same concept. The other option would be going straight to a corporate model. If you went to a corporate model and you issued stocks, you would have a secondary tax liability, but you would still be liable for the value of the stocks in general. So, yeah. But either way, I mean, on the other side, it's a really good thing if you actually have value and you're transferring your community equity into real equity and you actually have value for it. It's like, woohoo, I have value. How exciting is that, right? I'd rather have that problem than not have value to begin with, right? The other thing to do is that, and that's another why community equity is so flexible, is that, typically you know that everybody should get at least 10% equity. So let's say you have 6 people involved in creating a new company. Everyone automatically gets 10% equity, and then the additional 40% will become community equity. And then you over the course of 2 years, you figure out who does the most work in order to do the other 40%. But then everyone automatically gets 10% equity that they automatically have no future tax liability for unless they sell it. And then they have the community equity that if they decide to transfer it over, they would have a future tax liability for that particular transfer. But at least it wouldn't include the additional 10%. Yeah. Yeah, but the key thing here is that I just gave 2 or 3 examples, right? And what community equity does is it's so flexible. There's actually thousands of different options of how the community equity can be dealt with over time. And that's what's so powerful about it, is that you can do many, many different things that with a normal business structure are all but impossible. So in a normal business structure, you break out the equity between the 6 people. They all get different amounts of equity based on their contribution and their potential contribution and their the investments that they made. And then it's stuck, right? To change the equity, whether it's 1 year in the future, 2 years in the future, 5 years in the future, is all but impossible. And then furthermore, when you bring another investor for another round of investment, everybody's equity gets diluted, and your contribution means even less. So basically, it's a very, very different system when you use the normal equity system, where there's literally no flexibility at all. And community equity gives, in essence, unlimited flexibility. But the cool thing is that you don't have to have your entire business be community equity. You could just say that, oh, only 30% is going to be community equity. So you have 70% that's rigid and fixed, and then 30% that's more flexible. Okay. And just going back to the first 3 steps, that's why it's so easy to set up the community equity. I mean, you literally just decide to do it, choose a percentage, and choose a placeholder, and you're done.
Yeah, that is very simple.
Yeah. So the next step would be, if you are going to distribute the community equity, what is the final decision making for the distribution of community equity? So that's another good thing. But first, I really want to back up and make sure we've covered the setup process, because that's the most important thing.
Okay.
Did we do that? I mean, do you have any other questions about setting up? I mean, do you feel like we've, in a mock scenario, we actually did set it up, or did we skip a step, or?
I feel like
I think we did skip a step. Yeah, we skipped the step of choosing the placeholder. So we chose the percentage, which is 30%, but then you didn't choose a placeholder.
Correct. Yeah.
So I want you to choose a placeholder. And this is just a mock version. We were just like as an example. And this is really important for being able to talk about the distribution of community equity and the final decision making.
Yeah, I follow.
Because without the placeholder, you have no idea how the final decision would be made. But when you choose a placeholder, then it's like, boom, here's the example.
I got you. Okay. So I'm looking at the options again. I have in my, maybe it's your notes. No, I think it's my notes. Is there a difference between an organization and a 501c3? Because obviously the 501c3 is a type of organization.
Yeah. So any organization is possible. You could choose another business. I mean, basically the idea of an organization would be to have, the goal would be a third party, right? Because the idea of a third party is you're getting a neutral party involved so that there's not a conflict of interest. The whole idea of a placeholder, let me write this down. The whole idea of a placeholder is to reduce conflict of interest, right? So if all of the owners are the people who oversee the community equity, and in essence, the bad model, the fox being in charge of the hen house, then they could easily have a big conflict of interest to screw all the other beneficiaries and take all the equity for themselves, right? So the whole idea of a placeholder is to reduce the conflict of interest by getting a third party involved. So in the idea of an individual, you could have any individual who's currently not part of the business would be a third party. You could also have an individual who's neutral or an individual who's part of the business, but whatever, right? An organization would be any separate third party organization that's not involved in the business or involved in a certain advisory way or whatever. And it could be it could be another business. It could be, another entity. I mean, it doesn't even matter what organization it is. It literally could be anything, as long as they have the legal ability to own something. So, most likely would need to be some type of like LLC or limited liability partnership, something that has the ability to own something. But it really doesn't matter, because even with a partnership, you could have a group of individuals collectively being the, I guess I'll just add that. I'll just put partnership, a partnership, or a group of individuals. Okay? Does that make sense? So then you have the organization, and a 501c3 nonprofit is just a type of organization. And the reason why I bring that particular type of public charity organization is because it's already structured as a trust. And so because 501c3 public charities are, in essence, public trusts, they're a perfect example of what we're doing. And then the last one is the trust itself. Because it doesn't matter which option you choose, whether you choose the company and board itself, the individual, the partnership, an organization, or a public charity. In essence, you're creating a legal trust because it's a contract between the beneficiaries, the company itself, which is the one issuing the actual equity, right? And the trustee that's overseeing it. So any way you look at it, you're creating a legal contracted trust. It's just you don't necessarily have to create a separate trust entity to oversee it unless you wanted to, which is perfectly fine. Anyone can create a trust, and any of these could be sponsored organizations. And we didn't really talk about sponsorship, but that's obviously another thing here. So anyways, if you can decide what placeholder you want, I can go into the final decision making of the community equity. Either way, we're pretty much at time here, so we're going to be wrapping up. But
yeah, that would be good. Okay, so why don't we move forward with it doesn't really matter. It's confusing because they all essentially represent a trust, so why not just do a trust?
Well, the trust is obviously the most complicated because you're creating a whole new separate entity that is the trust itself. So that's why you would skip doing the trust, is because the trust is 3 separate entities in one, right? Whereas the just choosing an individual or organization is super simple.
Okay.
Does that make sense?
This is probably more realistic for us too, that we would choose an organization.
Just some random organization.
I mean, it wouldn't be random, no. I wouldn't think.
Well, I know, but you don't know what the organization is now. You don't know what it is. So it's some organization out there in the world.
Yeah.
Okay. So choose a organization as the third party. So basically what that means is it could be a business, it could be a nonprofit, it could be, some other type of corporation or LLC or anything. Partnership, cool. But the key thing is that it's a group of people and probably most likely a board.
Yeah, okay.
Now, there actually is one other type that you can do, is you can do basically a joint venture. A joint venture, which would be one or more individuals / organization. So for in the example of the World Play Ventures is a nonprofit joint partnership. No, nonprofit joint venture oversees the community equity. It's actually multiple nonprofits that have this decision making over the community equity. So you could technically choose more than just a single organization. Is my point.
What would drive that decision? Why would you make that decision?
Say again?
Yeah, why would you choose to split it up across multiple organizations?
Well, that just creates even less potential conflict of interest because you have, two organizations that basically need to agree in order to do it. So in the example of your situation with you have 30% community equity, right? And the idea of the placeholder is the placeholder actually has the ownership of the community equity, but it's not. But they're overseeing the asset for the benefits of the beneficiaries, right? So the if you're going to have two organizations, you would take the community equity and you would split it in two. So you'd have one organization would have 15% of the community equity, and the other organization would have 15% of the community equity. And so then, in essence, it's still 30% community equity, but you have two separate placeholders that are simultaneously overseeing it. That make sense?
It does.
Cool. Anyways, let's just stick with the organizational model. And we have basically, it's a third party, it's a group, and most likely it would be a board. Okay, so this would be the organization board. Okay. So if we have time, if you're not like busy and need to bounce, the question would be, how do you do the final distribution of the community equity? And this assumes that you tracked, all the time and contributions of the individual members. Let's say there's like 20 plus people. Okay. Do you want me to go over the setup for the example again, or are you ready to move forward?
Let's move forward.
Okay, and how much time do you have? Because we're at time right now.
I have, I'd say 10, I don't know about you, I have about 10 to 15 minutes of cushion. Okay,
well, this should only take like 2 to 3 minutes to do the example, and then you can ask more questions and we'll be done. All right, okay. So the first step for the final decision making is, getting the proposed version. And the key here is that that's the job of the placeholder. So step 1 would be the placeholder, crunches the numbers of tracked time and contributions and creates the initial proposal. Right? Are you still there?
Yep. Yeah, I just had it muted. That's all, because that's some background noise.
Oh yeah.
Yeah, I'm
So
here.
so that's pretty much it, right? But the key thing is that the placeholder in and of themselves doesn't have full 100% control of the community equity. So if the placeholder presents a distribution of community equity that everybody else agrees with, then it's a done deal, right? So if everyone agrees to this proposal, it is a done deal, right? So you don't even need to necessarily have a formal process, right? The placeholder can just oversee the community equity if everyone trusts them and everyone likes it. Boom, done deal. The second step would be is the board. So this is the board. And this would go through. This would be finalized by the organization board. This would be the placeholder. Okay. So then, if the board approves it and everyone's good with it, then you're good. So step 2 would be like if there's a problem, right? So problems So if the board of the business or company had an issue with the way the community equity was distributed, then they could basically propose an amendment, right? And it would go back and forth between the placeholder organizational board and the board of the business slash. Do you understand step 2? Yes. If the board of the company felt that the placeholder did not have the best interest of distributing the community equity with integrity, there is a way for the placeholder to be replaced, right? Replaced. The placeholder will be replaced. So the key thing here is that the board has a lot of power, right? The business board or company board has a lot of power over the community equity, specifically the placeholder. In the highest level of that power is in replacing the, in essence, the trustee or placeholder. Okay? That makes sense? So if the company wanted to get rid of the community equity entirely, that's a huge problem. But if the board wanted to just simply replace the current placeholder, for example, let's say they chose the placeholder to be an individual and they're like, well, this isn't fair. That individual does not have the best interest of the beneficiaries in the company in mind. So let's replace them with an organization, right? Or they didn't like this organization, and they chose a nonprofit, a for-profit, they wanted to choose a nonprofit. So that process is pretty easy. There are sniffles and snags in there, but that's why the board can still be involved in the community equity distribution process. So step 3 would be the beneficiaries have a problem. The beneficiaries can collectively, basically, what do you call it? They would collectively write out grievances.
Okay. Yep.
To the placeholder, and the placeholder can literally, fire the board because it's an owner. It's an owner of the company, right? So in other words, like if there's this is only 30%, but in a situation where you had 50% plus 1, for example, World Play Ventures, the placeholder or the community equity beneficiaries could literally fire and replace the board to have a different board. So there is there's a whole relationship between the 3 organizational groups. And the beneficiaries have the least amount of power in deciding who gets the equity, because they would have the highest conflict of interest. And then the second most is the company board itself. And of course, the one that has the most power is the placeholder. So does that make sense in terms of the final decision making?
Yeah, no, that's pretty easy to follow, I think.
And that's also why once you decide the percentage and who the placeholder is going to be, you don't have to do anything else. The placeholder basically just comes back to the company at some point and be like, okay, here's the current distribution of the community equity.
Yeah.
And there's no need to actually go through all the trouble to calculate and figure out all the distribution of the community equity, unless 1, you want to, and 2, there is enough data and time to actually calculate it out, because if there's not any data, then you can't do it. And then 3, why go to all the trouble to calculate all the hours that everybody has put in and distribute all the community equity if there's no value, right? So if the company never has value and there's no money to distribute and there's no profits, then it's pretty pointless to do that.
Yeah, that makes sense.
Yeah, so that's part of why community equity is really good, because basically you can set it up and then only move forward with it when the time comes that it's necessary to do that. Cool. So I think we're done. Did you have any other questions?
No, not off the top. I definitely will sit with this, review this myself, as well as share it with the team. Will this document that you created also be available for viewing?
Yeah, it'll be public, dude. All this is public. We have the videos, we've got the audio recordings, so it's all ready and good to go publicly.
Okay, cool. Very good. Yeah, I'm all set. That was about probably as much as I'll be able to kind of digest for the day anyway, because a lot of that was new to me. I think at least the finer details were new to me, not the overall explanation, but the finer points. So,
yeah, cool. Yeah. Well, yeah, just to overview, and as you take this back, for me, the most important thing is to understand the simplicity of setting up, that it's just deciding to do it, choosing the percentage, choosing the placeholder, and then the simplicity of breaking out and distributing the community equity is really up to the placeholder, and they would just look at the data based on the contributions and split it up in a fair way. So and as long as everybody's happy, it's perfect. If people aren't happy, there's ways to mitigate that so that both the company and the board itself can be involved, as well as the beneficiaries and the community of the company. So I think we're good. So let's talk again in the future when you guys have more details that you need to work out. And also, if you wanted to have like me come to one of your meetings, to help present or discuss, where you had more people there, or we could even bring it into one of our collaborative company meetings. And I'm also want to propose on Saturday that the collaborative company does implement community equity as well.
Yeah.
So that could be a good practice point for reset, is that you could use the collaborative company as a practice run, and then do it for reset later. Okay.
Yeah, I think that's a great suggestion, Jay.
Yeah, and definitely check out the website that I put together, because it has pretty much everything on there, and I'll put this information as well.
Sounds good.
All right, man. Good work. Thanks so much for your time and going through all this.
Likewise, Jay.
Good for me too.
Thanks for your time. It was awesome, man.
Awesome. Ciao. Bye.
Goodbye.